All right, 101. We'll go ahead and get started today. Thanks everybody for taking the time today to join us on the non-QM 101 webinar. This is going to be the start of a series for basic progress through what non-QM lending is, how to calculate income, how to qualify borrowers, solve problems, and even how to sell the loans through to the end clients. My name is Paul Sashariba. I'm the non-QM division manager here at MLB. I spent the majority of my career sitting in your shoes, actually. I spent most of my career as a producing broker, closing as many as 300 units a year on my personal team back in 2020. We did a lot of non-QM, we did a lot of VA in that environment. So my experience comes not only from closing non-QM on the wholesale side, but also from doing it in your shoes at a very large volume level. The first thing we want to talk about is what really is non-QM lending. Non-QM lending is a way to get around some of the requirements in the qualified mortgage rule. Now, that does not mean that you don't need disclosures on a non-QM loan. It doesn't mean that it is subprime. We'll get to that here in a second. Non-QM is really an alternate way to document income, right? The qualified mortgage rule gives us rules on how to document income and a borrower's ability to repay, ATR. In the non-QM space, we still need on a income qualified loan to satisfy ATR. We're just using more creative income calculations to do that, like bank statements, P&Ls, 1099, and other avenues. It allows us to have manual underwriting flexibility. So every loan in the non-QM space is 100% manually underwritten. Sounds like a pain. It does take a little bit longer to get through underwriting, which is why non-QM turn times can be a little bit longer, but it gives us the ability to tell the story. It gives the underwriter the ability they had pre-2008 to go in and make a loan make sense, that the AUS cannot decision correctly because it can't make subjective decisions. So the core concept really is using alternate documents to satisfy the ability to repay, or using the debt service coverage ratio for an investor to show that the property itself on a business purpose investment loan is cash flow positive or neutral. The big elephant in the room is really that non-QM is not subprime, right? Pre-2008, ninja loans, no income, no job. Some of that stuff is kind of making a comeback right now in a small way, but it's doing it with a lot larger equity stake. No real predatory terms, no poor credit, not as much poor credit as there was back in 2008, and more regulation, more rules being followed to produce higher quality loans. Modern non-QM provides that income flexibility. So we're still verifying income. And I would argue that on a bank statement loan for a self-employed borrower, we actually see a better real world picture of the business than you do on tax returns. So it's actually a better way to document that business income. From a risk standpoint, there is a little bit of risk in the alternate income calculations. But again, we're seeing a lot of that business data on a bank statement loan or a 1099 loan. We can see the actual income coming in. And the performance of most of these alt-doc products is on par with Fannie Mae conventional, maybe slightly higher depending on the exact documentation type. So we're really trying to curtail that risk versus what happened pre-2008, where we were lending 100% no income stated doc loans. So very much a different environment than subprime, not geared towards the people that just can't qualify. This is geared towards people that need an alternative means to qualify. Who's the perfect non-QM borrower? There's a couple of different income sets here, or income calculation sets. There's that self-employed borrower. It's highly likely that on a bank statement income calculation, given that the average borrower writes off everything they can on their taxes to avoid that tax liability, we're going to see between 50 and 100% more income on the bank statement calculation than you see on income taxes on average. The real estate investor is another great place, DSCR, right? We don't care about other properties owned unless they're mortgaged. And that even at that point, we only have to prove that their mortgages are current. We're not cash flowing those mortgages. You don't have the max 10 property rule like you do with Fannie Mae. You have one property, one loan, and we really just look at that subject property from a qualification standpoint. If that property is cash flow neutral or positive, you've got a great DSCR there. There are options to look at that property as a negative cash flow as well, but it will take a stronger equity position and a stronger borrower. The retiree is another great non-QM possible borrower. They sometimes have assets in either 401ks, IRAs, retirement accounts of other kinds, investment accounts. We can use asset utilization, an asset depletion mechanism to satisfy ATR. Yes, you can do that on Fannie and Freddie. However, you're going to deplete those assets over a 240-month or a 360-month term. Depending on which program you're in here at MLB, we'll deplete it as low as 36 months or as much as 84 months, depending on exactly what loan program we're in and what your DTI is before applying that asset utilization income. The other place non-QM is very strong is multi-income borrowers. So think your gig workers, families with multiple different streams of income. When you need to use some of those assets they have in asset depletion along with their retirement money coming in and maybe a side business that they operate, they do woodworking at craft shows or something like that in that scenario. It gives you a lot of flexibility to take today's more complicated borrower with multiple jobs, multiple income streams, and package them in a loan to meet their needs for housing. The MLB wholesale advantage. Non-QM is driven by common sense underwriting. We really try to stick to the core of what we have to prove in the guidelines. Sometimes that doesn't always make common sense. I use the joke sometimes with folks on the phone. You're making the very common misconception of applying common sense because sometimes in non-QM, just like agency or VA, you're looking at a rule that's a rule because the guidelines say so. And that just goes back to a sellability component of the loan. But we try to apply common sense and only condition for those large deposits on a business bank statement loan that really are questionable and not able to be identified as business income. We try to make that story make sense. And one of the things you can do through the loan process on a non-QM loan to help that story make sense is write a cover letter. Give the underwriter the story. Help them understand exactly what we're doing on a more complicated loan. If you're using 3 or 4 sources of income, to understand what they're packaging together and where the strengths of that borrower actually are. Non-QM, while the initial underwrite might be a little slower, you can still have extreme speed. We were able to close a purchase of a non-warrantable condo the other day for somebody in 7 days. We couldn't even close the loan. It's still a TRID compliant loan. We ended up closing it on day 10, but we had that loan CTC'd 7 days from submission on a non-warrantable bank statement qualified condo purchase. We also offer marketing support here at MLB. There's a great flyer library on our resources tab on our webpage. The marketing team can customize that for you to use with your realtors, your end clients, to help you generate more non-QM business in what is a new and expanding space this year. Last year, non-QM lending made up about 10% of all loans written in the country. That is a number that I believe is going to come close to doubling this year. We're going to see a lot more non-QM production this year. How to sell non-QM to the client, right? It is a little more expensive in terms of rate. We don't have the reps and warrants or the mortgage insurance components you have on the Fannie Mae, Freddie Mac, FHA, VA loans. So those rates do come up a little bit higher. And there's a couple of objections that you'll see in terms of client questions with that higher rate. One of my favorite ways to address that, especially with a self-employed borrower, is, Mr. Borrower, do you really want to wait 2 years, file new taxes, pay that tax liability so that you qualify on a full doc loan just to have a lower rate? Or in reality, is it actually cheaper for you to take the higher rate today on the mortgage, have the housing you're looking for, and pay less in taxes on your income for the business? And a lot of times, if you actually run the math, that will hold true. The increased tax liability to show enough income on their taxes would be more expensive than the 10-year cost of the higher rate on the mortgage. And we all know that most mortgages don't last for 10 years. So the odds of them encountering a 30-year cost, which is what's presented on your disclosures, are very minimal in terms of actually holding that loan for that long of a time. Another strategy we can use quite a bit is, right now you're not showing that income on your taxes, but let's get you into a non-QM loan now. That'll give you 2 years to file those taxes in a way that would allow you to qualify for a conventional loan down the road, and we can refinance you to a lower rate if rates are in line at that time. Call that the bridge strategy. The other one is investor growth. So for those DSCR borrowers, it is a great tool to grow their portfolio faster. They need less reserves than they do on a traditional loan because we're only looking at reserves on the subject property, not all properties held. And we can allow them to leverage their cash, even on a 4-unit property up to 85 LTV. They can use that money to buy more doors quicker than they can on a Fannie Mae loan with less restrictions. And in the DSCR market, the way it is today, you can get a rate under 6% on a DSCR mortgage. So you can get a rate that is not only competitive, but in a lot of ways better than Fannie Mae. We do have a component on those rates, though, for DSCR that are prepayment penalties. So that's something to learn to address with the client because the length of that prepayment penalty is going to directly impact the interest rate you can offer to them. The blueprint, kind of how to start a winning scenario. Don't guess, right? We understand that mortgages, non-QM mortgages are about 10% of the market, right? You probably haven't done 100 of these scenarios in the last couple of years. You're going to need some help. Get us involved early. Let us help you figure out the right income strategy, how to tell that narrative, document that self-employed income, and provide clarity upfront at pre-approval. Myself, Celine here on my team are your primary contacts for that here at MLB, and we both come from your side of the fence. We've got history both as a processing, third-party processor, and as a mortgage loan officer, branch manager. We've packaged these loans live in the field before. Let us use that expertise along with the guideline expertise we have here at MLB to help you package the loan correctly, pre-approve it correctly, and then get it through the process as smooth as possible. Because with so many caveats and so much gray area in the non-QM space, packaging that loan accurately and correctly up front is extremely important. It's got to be put together correctly to tell that story, and the better it's put together up front, the smoother your underwriting experience is going to be. Checklist for success. Before you hit that send button, make sure that you've got a breakdown of your assets, right? You're sending us a scenario. Make sure we know the assets. Make sure we've got a good housing history. We don't require 24 months on non-QM. We require 12 on every loan. However, 24 months can improve your pricing, and it can help strengthen what would be a weaker scenario otherwise. Whether that is living rent-free for a time period, or a rent, or a mortgage, that 12-month housing history is important on all non-QM loans. It's something that's going to come up in every one of our non-QM guidelines, from DSCR to first-time home buyers on a bank statement loan. So that's an important one that you don't always have to get a hold of, but we do need that core history. When we're pricing out a scenario as well, the pricing will vary a little more than it does in your Fannie Freddie scenarios. Purchase price, loan amount, FICO score, prepayment penalty on a DSCR are all going to affect your pricing. There's a much larger pricing spread from the lowest rate to the highest rate available because the non-QM bucket moves a little bit more. So a 800 credit score, 50 LTV bank statement buyer is likely today to be in the low 6% range, but that same buyer, 800 credit scores at 90 LTV, is likely to be up closer to the 8% range. Because again, there's no mortgage insurance. So that higher LTV comes with a much higher rate to compensate for the mortgage insurance. So for non-QM, the details matter in your price quote, and they can move you quite a bit up and down the spectrum. So the details on a quote are very important to us to be accurate so we can help you package that loan correctly. In general, exploring non-QM options. Bank statement lending is one of the predominant non-QM forms out there. It can be either 12 or 24 months of business bank statements. There are opportunities to work with people that have been self-employed for 12, 18, 24 plus months. When you're at 18 and 12 months, there are a few more restrictions to keep in mind, like you need to be able to prove a 3-year prior history in the industry. But 24 months and out in self-employment in the same business, you've got a nice clean loan to start with. DSCR. This one causes quite a bit of confusion. DSCR is for investors only. We're not going to do a primary residence or a second home DSCR. This is a loan geared to making money through real estate, right? Building an investment portfolio. But it's a way to do that with absolutely no income on the 1003. And as a matter of fact, when you submit a DSCR loan, you should have no income or employment on your 1003. I don't want to see it there at all. You can actually cause yourself issues by disclosing that on your 1003. Alt doc and full doc is a generalized category. That will include everything from 1099s, bank statements, P&L, P&L only, or P&L with 2 months of bank statement support, asset utilization, written VOEs. And in our MLB mix and match program, you have the ability to blend all of those income types together, with the exception of DSCR, to get a borrower qualified. One of the other unique points in our core non-QM products, and we have 2 different versions. We have the premium products here at MLB and the core. The core gives you the flexibility. The premium gives you a little better pricing for a much cleaner loan. So depending on the borrower you have 2 different options in Guideline, one with more flexibility, but it doesn't always price the most competitive, and premium that prices a little bit better but requires a cleaner borrower. So we separated those out instead of putting them in one guideline set to better price that premium borrower in. That's not to say that you can't have a core borrower that does price competitively depending on the scenario. It just depends on why we're using that core product. In the core product, we can bring together a bunch of different income types. So we actually just closed a loan recently for a couple. They were buying a primary residence, 3-unit up in New Jersey. The husband was a W-2 guy with the trades union. He also did the exact same job for himself, evenings, weekends on the side. We documented that side work with bank statements. Got 12-month bank statements for him. He'd been doing that for about 5 years in conjunction with his prior job. That wasn't enough money to get them qualified for the home. We did use rent from 2 of the 3 units to help offset some of the costs for them. The wife was a 1099 nurse. We gave her credit for that 1099 income. And on top of that, we used both of their retirement accounts for asset depletion. So we packaged together 5 different streams of income for these guys to get them into a $1.2 million house as a primary residence. Plenty of opportunity for that kind of flexibility, but it does take some creativity and some thought about how to package that together to know which components we need to use to get the client across the board. When we do that, we're going to take whatever the most risky income calculation type is, and that's going to set our LTV max and our overall pricing, since different income calculation styles are going to price differently in the non-QM space based on risk. So if you're ready to win some more deals with non-QM alternative options, we're here to help you in any way we can. Cell phone number is on the screen there. We have a great scenario desk. Celine and I man that scenario desk for you, and we try to keep that to 2-hour turn time throughout the bulk of the workday on the East Coast. So generally between 7 a.m. and about 7 p.m. Monday through Friday, we're on a 2-hour turn time for that scenario desk. Feel free to call us, text us, email us with any scenarios you have. We're here to support you and help you learn non-QM, not just close one loan. Does anybody have any questions? We'll hang out for a little bit here and answer any questions you might have about non-QM options here at MLB.
No, thank you very much.
You're welcome. Next week, we are going to be talking about the next evolution in the series, and we're going to continue that series all the way through the month of March. So we'll be doing bite-sized pieces of non-QM all March.
Hey, Paul, quick question.
Yes, sir.
Can you do a interest only DSCR?
You can, and you can actually use the interest only to calculate your DSCR ratio down to 0.75%. The only time you cannot use interest only on DSCR is if you're going to go with a true no ratio, where we don't care what the ratio is.
Okay, so I mean, if somebody and a refi, no interest is certainly in the game, right?
Absolutely, yeah.
Yeah.
So there's a little bit tighter restrictions, right? You're going to need to have a 680 plus FICO score borrower and a max of 80 LTV. But at that point, I will look at that as an interest only loan and qualify on the interest only payments.
Is it fair to ask you today what an interest rate would be on that? I mean, I know there are a lot of variables, but
So it's fair to ask. You can ask me anything you want. It's not fair to answer. And right, because that loan could be 6.5 today, interest only, in a great DSCR scenario with a 3-year prepay or 5-year prepay. If
Mhm.
you're looking at an 80 LTV, 680 credit score, $150,000 loan amount borrower in New York, that's a little bit higher risk, that
Mhm.
same loan might cost you 7.75. So
Is
it
there a
can move quite a bit, which is why I say it's not fair for me to answer, right? It's very
no,
scenario driven.
no. I'm sure we have a way to contact. Yeah, I'd like to talk to you. Uh, is there a limit on the amount of money you can borrow per unit?
So the max cash out on a DSCR is 75 LTV, but we'll carry that up to a $2 million loan amount.
Okay, but as far as the loan amount, is there a max? Like 5 million, 2 million, 3?
Yeah, so in our DSCRs, we'll carry them up to a $3 million max loan amount.
Okay, gotcha. Thank you.
Yeah, you're welcome. Now keep in mind in non-QM, the matrix dictates everything.
Gotcha.
Let me pull this down for just 1 second, and I'll pull up one of our DSCR products. This is our DSCR core, so this gives you the maximum flexibility in a DSCR product. The matrix is really the key. Anytime you guys are used to running AUS, replace that part of your process with check the matrix, because all AUS is really is this in a computerized format. It's Fannie Mae checking back against the matrix. So you'll see as your loan amounts go up, your LTV restrictions change and your minimum credit score will also change. So depending on your exact scenario, this is why I say that with that pricing, right, it can vary so much. Every one of these buckets has the potential to price differently.
Mm-hmm. Okay, great. Thank you so much for that.
Yeah, you're welcome. But yeah, absolutely. We can, Celine, can you put my
Yeah.
cell phone in the chat, please?
Yeah, it is. It is there. There's another question. What would be your best marketing advice for the team, for the group?
From a non-QM standpoint, my best advice is to go after one of 2 sets and focus on that. Become an expert, first of all, in DSCR and try to help people build wealth through real estate and show them the ability to expand their portfolio faster with non-QM lending by either putting less money down, buying multi-units, something to leverage that DSCR opportunity to get them more properties faster than they could in a traditional sense, right? If you got a Fannie Mae loan, after your 4th loan, you're now into multi-finance properties. You're going to have reserves on 4, 5, 6 properties at some points. DSCR, I only need reserves as little as 3 months, depending on the borrower and the property, on the subject property alone. That means you could actually do 3 DSCR loans with me at the same time and have one set of reserves cover all 3, because I'm only going to underwrite them independently on the same bank statement. So it's a great way to leverage their cash more and get more doors faster to increase their profitability. From an alt doc standpoint, become an expert in helping self-employed borrowers. And the best way that I was able to market that myself in the field was to go to business networking groups and build relationships, because business owners know other business owners. So I took the realtor out of the mix completely. I went to business networking groups because every client in that room is either commissioned, 1099, or a business owner themselves. They are the non-QM target market. So everybody in there either knows somebody or is a client themselves. Present yourself as the expert that can help make that work. I'm not just the mortgage person, but I'm the mortgage person that understands how to analyze a business person purchasing a property and look at, do I need a P&L on this one? Do I need 1099s? Do I need bank statements? And what's the best avenue, not only in terms of cost, But if the goal is just to get a house, how do I get this client across the finish line? And I presented myself as the undisputed expert in making things happen, not just closing a mortgage. Non-QM gives you the flexibility and the guidelines to make a lot of those things happen, package multiple income streams. You're probably not that expert yet today, but you can present to be that expert and then lean on us to help you at the pre-approval. We'll give you the right ways to put these things together to get the client across the finish line. But I did it through grassroots marketing. I did not use a lot of social media to build that. I liked shaking hands. It built relationship. Yes, it was a little slower, but it turned out to be a lot more referrals over time because it built solid relationships that lasted. Any other questions?
What's the minimum DSCR loan amount?
Minimum DSCR loan amount is 125 without an exception. So we can play down to 100,000. However, under 125, the LTVs start getting tighter than they are positioned on our matrix. If you're going to do a purchase loan at 85 LTV, the minimum loan amount for that is 150,000.
Awesome. Eric posted, did you market yourself to companies like Edward Jones?
I absolutely did, Eric. I didn't do Edward Jones for one specific reason. Edward Jones has a relationship with a mortgage company where they'll pay their advisor a referral fee and they get them licensed. They get them a license. So I avoided Edward Jones. But one of my largest sources of business in the last couple of years I was originating was actually Northwestern Mutual. And I put a foot in that door for alt doc lending, certainly for bank statements. They know a lot of self-employed clients. But the way that I like to get financial advisors interested is asset utilization. Mr. Advisor, what if I could give you an avenue when your clients call and say, hey, I need money for a down payment. I want to withdraw from my investment account. Or I'm buying a house. I want to withdraw enough to buy the house cash from my investment account. These advisors are paid on a fee for service or a fiduciary basis. Most today are fiduciary requirements. So what that means is they get paid a percentage of the assets under management, generally 1% or so. They don't want to lose that money out of the account any more than the client really wants to lose that money from growing. So if we can present an option where they never touch that money, yet we turn it into income and then give the client the option of how they pay that, whether they do take a distribution, whether they've got income from other sources we're just not documenting. We keep that money in the hands of the financial advisor where they still get paid. It still grows at a rate that outpaces the mortgage interest cost for the client. We can actually put the client into a better financial position by leaving that money invested, but still using asset utilization to leverage it for income. And that was the calculus that I walked financial advisors through to start getting them to refer us business. Because it's a very powerful tool to leave that money invested. They don't pay capital gains tax on it. They don't have a tax burden from whatever that liquidation is. They still get to leverage it as income to prove that they can pay the loan back, satisfy that ATR requirement, and they get the house they're looking for. And most clients in that scenario have other means to make the payment. They just don't have a traditional documentable source of income. So it can be a great avenue, and most financial advisors have absolutely no clue it's possible. Yeah, you're welcome, Eric. Feel free to call me as well. We're happy to talk through that in more detail with you. And we're going to go into that a little bit more depth. I believe that's part of week 3. We'll go into that in more depth and much more sales strategy in week 4 of the series. Does anybody else have any questions?
Yeah, I do have one, and this is a rookie question, so don't laugh. So do you charge an origination fee? Are you a wholesale lender?
We're a wholesale lender. I charge an underwriting fee.
Okay, but not a origination fee.
Now, correct.
Okay.
I'm just here to help you guys as a resource from MLB to help you grow your business by teaching you non-QM.
Great, perfect. I'll tell you what, you're striking on all cylinders. Good deal.
So, and I really mean that, guys. We're here to help you package these loans. When MLB hired me, they brought me in to build non-QM lending from an originator's perspective, right? The first thing I noticed was originators don't know non-QM. It
Mhm.
takes a lot to learn it. You've got to do a lot of reps to really learn it. So what's the best way we can support you? Helping you learn how to tweak, package, price, get these things through the process smoothly. But somebody's got to teach you when only 10% of the market's making up the product, right? It's just not common knowledge. So we are here from pre-approval to closing and post-closing to help you guys put these things through the right way.
Paul, I do want to add something to the team. I think that one of the benefits we do bring is, like, for example, we review a scenario for a bank statement loan. After we did the calculation, it didn't work, but it did work in a P&L program. So we were able to reach out to the broker and say it didn't work in this program, but it definitely fits this one. That's what a partner is, and that's what we want to be for you guys. We want to review this for you, and we want to earn your trust because we want to be a loan partner for you and your business. So that's what Paul and I are trying to do here is be that for you while you learn. We want to be able to structure these deals for you so that at the end of the day, it gets to the closing table.
Celine, you're absolutely right. Then when we do that, we ask you for bank statements early on in the process, right? We really want to do the bank statement review at pre-approval. And the reason we want to do that is we want to look at those 12 months of statements and identify what problems we have on the bank statement calc. Can we solve those? If so, what documentation do we need you to provide to do that? And if we can't solve them, what other alternative documentation type do we have that might fit for the scenario? So we spend a lot of time starting with bank statements, but maybe converting to P&L or converting to asset depletion, depending on what we can and can't show on the bank statement analysis. Or this time of year, the other real common one is we see a decline in income. We have a landscaper that just hasn't made a lot of money in the last 6 months. So it looks like they make 50% less right now than they did in the first 6 months of that calculation. That's a problem. We have to show that that business is not going to cease to exist. So that is either a opportunity to convert to a 24-month analysis and show seasonality, move to a P&L type loan so we don't see the individual monthly variation, but it gives us the opportunity to help you restructure that loan before you're in contract, which makes it a lot easier than solving the problem once we're in process with a closing date. Any other questions I can help with? Excellent. We'll be back at 1 o'clock next Friday as well with the next iteration of the series for Non-QM 101 and every Friday this month at 1 o'clock Eastern. You guys have a great weekend and please reach out with any questions.